So in our last explainer, we really dug into how you can spot QQQ reversals when those big institutions are secretly selling up at resistance levels. Well, today, we're flipping that coin over. We're going to uncover how to find the accumulation zones, the exact spots where that same smart money is quietly buying at support, usually right before a big move up. By the time we're done here, you'll know exactly how to read those dark pool buy signals and pinpoint the levels where the big players are loading up, so you can finally trade with them, not against them. All right, but before we dive deep, we've got to get the important stuff out of the way. Please remember, this content is purely for educational purposes. It is absolutely not financial advice. All trading involves a ton of risk, and you should always do your own homework and talk to a professional. Okay, with that said, let's get into the good stuff. Here's our roadmap for today. First, we're going to talk about why understanding this institutional edge is such a game changer. Then, we'll get our hands dirty and learn how to decode the clues they leave behind in dark pool prints. After that, we'll build what I call the triple confluence zone. This is where the really high probability trades are born. Then we're going to wrap it all up into a super practical, step-by-step accumulation trade checklist. And finally, we'll see how this whole strategy fits into a bigger system of trading with the house. Okay, let's kick things off with the most important idea of the day, the institutional edge. This is all about changing your entire mindset, moving away from basic retail chart patterns and learning how to spot the actual footprints of the giants. So let me just ask you this. Do you ever feel like you're trading against the smart money? Because the truth is, most retail traders are. They're all looking at the same old charts, the same indicators, and they have no idea they're on the completely wrong side of a massive institutional order. You see, these big funds don't just wake up and randomly smash the buy button. No way. They have a plan. They quietly, strategically, and methodically build massive positions at key levels. And our whole goal, our entire mission, is to learn how to see what they're doing before that move becomes obvious to the entire world. And that brings us to the key definition for today, institutional accumulation. Now, this is not just buying, not even close. It is the strategic, slow, and quiet building of a huge position over a period of time. They do it at very specific price levels. And here's the kicker. They almost always use off-exchange venues, like dark pools, for one simple reason: to avoid tipping their hand. I mean, if they have to buy millions of shares, they can't just do it on the open market without sending the price to the moon. Our job is to be the detective and find the evidence they leave behind. So, now that we know what they're up to, how in the world do we actually see it? Well, it's time to learn how to decode their secret language, the dark pool prints. Okay, so when a dark pool print comes across the tape, I want you to think of it as a clue in a mystery. And to solve it, you've got to analyze 4 key parts. First up, size. Is it big enough to matter? For a huge ETF like QQQ, we're talking anything over 300,000 shares. That's our threshold for institutional. Second, the side. Simple enough, right? Are they buying or are they selling? We're hunting for buy prints. Third, and this is absolutely critical, the price level. You see, context is everything. A giant buy print in the middle of nowhere is just noise. But a giant buy print right at a key support level we've already identified, well, that's a massive signal. And finally, number 4, timing and clustering. One big print is interesting, but multiple large buy prints all happening in a really tight price range and within a few minutes of each other, that's not a coincidence. That is a clear, undeniable pattern of institutional accumulation. And what's so great about this is how clearly you can separate the signal from all the noise. Just look at the left side here. That's the institutional pattern we're looking for. Multiple, large, consistently buy-side prints, all bunched up at one specific price in a tight time window. That's your signal. Now look at the right. That's just random market noise. Small prints, a mix of buys and sells, scattered all over the place with no rhyme or reason. The absolute first step to getting an edge is learning to completely tune out the chaos on the right and laser focus on the clear pattern on the left. Now, this is where we really take our analysis to the next level. A single signal is good, but the most powerful, highest probability setups, they happen when multiple totally independent institutional forces all line up at the exact same price level. We call this the triple confluence sound. And this slide right here shows you the 3 pillars that build that zone. First, we find GEX Support. GEX, or gamma exposure, tells us how options market makers are positioned. A high positive gamma level acts like a powerful magnet for the price. It's a floor that dealers have a huge financial incentive to defend. Second, we look at volume profile support, and specifically the value area low, or VAL. This shows us the price where the most trading has happened in the past. Think of it like a historical battleground, a place institutions are very likely to defend again. And third, our real-time confirmation, dark pool buying. This is the final piece of the puzzle. We actually see those huge institutional buy prints hitting the tape right inside this zone we've already marked. When all three of these line up, you've basically found an institutional fortress of support.
Okay, so we've covered the theory, we know how to find the zone. Now, let's make this real. Let's turn this whole concept into an actionable, repeatable trade plan. This checklist is where it all comes together, and it's designed to be followed step by step, no emotion involved.
Now, the most important thing to get is this. We are not trying to predict anything. We are simply reacting to a complete set of validated signals. So here are the 7 confirmations. Number 1, the price has to be trading at our triple confluence zone. Check. 2, net gamma has to be positive, which tells us the market is in a stable environment. 3, we need to see that dark pool buy clustering. I like to see at least 1.5 million shares bought to confirm it. 4, we have to wait for a bullish reversal signal to actually print on the chart like a hammer candle. This is so important, we never try to catch a falling knife. 5, the price needs to be above the 0 gamma level, which is our line in the sand. 6, we think about the time of day. We want to avoid the crazy open and the volatile close. And finally, number 7, just a quick sanity check to make sure there's no big news, like an FOMC meeting that could just blow up the trade. It's only when all 7 of those boxes are checked that we consider it a high probability entry. And I really want you to let this sink in. Even when all 7 confirmations are lighting up bright green, this is not a crystal ball. There's no strategy on Earth that works 100% of the time. What this entire framework does is it stacks the probabilities so heavily in your favor that you are, for all intents and purposes, trading with an institutional-grade statistical edge. And that means proper risk management is and will always be the number 1 rule. Okay, let's zoom out for a minute, because this isn't just about one long setup. Let's look at how this accumulation strategy fits into a complete, well-rounded system for following the smart money, no matter which way the market is heading. The entire strategy we've mapped out today, spotting accumulation at support, is just one side of the coin. The other side, which we actually talked about in a previous explainer, is spotting distribution at resistance. The logic is exactly the same, just flipped upside down. Instead of an oversold market at support, you're looking for an overbought market at resistance. Instead of hunting for dark pool buying, you're on the lookout for huge dark pool selling. And instead of going long, you're looking to go short. Once you really master both of these setups, you have a complete system for trading in sync with the institutions, whether they're buying or they're selling. And this quote just perfectly sums up the entire philosophy here. Stop trying to predict where the market is going to go tomorrow or next week. Your job is not to be a fortune teller. Your job is to be a detective. Your only focus should be on observing what the biggest, most informed players on the planet are doing with their money right now. Trust me, their actions on the tape will always speak louder than any market forecast you'll ever hear. Now, the source material for this whole deep dive comes from an incredible channel called Elite Trader Radar. They actually keep this series going and get into even more advanced stuff like institutional order blocks and fair value gaps. So look, if this explainer gave you a new perspective or a new edge, I really recommend you go check out their channel and hit subscribe. And of course, if you found this breakdown valuable, do me a favor and hit that like button, share it with another trader who needs to see this, and subscribe to this channel for more explainers just like it. Thanks so much for watching, and trade smart.